Hello, and welcome to Portfolio Matters Weekly Update, Week 86. But before I get into it, I will read the disclaimer. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Full disclaimer can be found at the end. Okay, before we get going, a bit of housekeeping. Now, I'm afraid I am doing this podcast on my own because Richard has the flu. But I hope he will be recovered in time for pub night on Tuesday. Reminder, we are meeting at the Princess Louise on High Holborn at 6 o'clock. I hope to see you all there. Okay, lots of news this week. So the big news was the Fed meeting. The Fed raised rates by 0.75%, but in its comments, it said that it saw rates peaking at 4.6% in 2023, which was above previous expectations. As a result, bond yields moved higher and bond prices sold off. The Fed has also stopped buying mortgage-backed securities as of last week, and US 30-year mortgage rates have hit 6.25% this week. The Bank of England also met and raised rates by 0.5%, which was below expectations. And today, we have the mini budget, and the government is expected to cut taxes, amongst other things, which will exacerbate the fiscal deficit. And sterling has had a very bad week. We will go into that. So in Ukraine, the war is going badly, and Putin has doubled down, and he has ordered the mobilization of reserves and a referendum in the occupied parts of Ukraine, Donetsk and Luhansk, on whether they will join Russia. Now, the results of those referendums are a foregone conclusion. And when they become part of Russia, he has stated that he will use nuclear weapons to defend Russian territory. Now, last week we discussed the war in Ukraine and Putin's likely next moves. And to me, I think he has no off-ramp and is likely to escalate. And I very much fear he will use nuclear weapons. So the Swedish central bank also met this week, and they raised interest rates by 1%. And in the UK, we had the announcement of business energy subsidies in addition to domestic energy subsidies, and we will go into that in some detail. So some charts relating to the news. Well, this is the latest Fed dot plot. Now, reminder, the dot plot turns out to be actually a very poor forecaster of the Fed's own interest rates, but the latest dot plot rose again, and you can see in 2023, the Fed is now forecasting that its own interest rates will be between 4.5 and 5%. And later this year, rates are forecast to be between 4 and 4.5%. Rates are expected to stay higher for longer. So markets are pricing in a Fed funds rate for the end of the year of around 4.5%. And the speed with which the Fed is raising interest rates is high by historic standards. So you'll see that interest rates have risen faster in the past, but the black line is the current tightening cycle, and it is fast. And bear in mind that in 1980, when the Fed's fund rate rose the fastest, it was on its way to 15%. So part of the Fed's aim is to produce some slack in the jobs market, and that means weakening the economy and increases the likelihood of a recession. And we think there's going to be a hard landing. On Wednesday, after the Fed meeting, bonds actually rallied and yields fell. But then on Thursday, the market went away, thought about it, and bond yields sold off. So bond yields rose sharply. So on to this week's economic data, and you'll be relieved to know it was a light week. Now, last Friday, we had UK retail sales, which were disappointing. So in July, retail sales were declining at an annualized rate of 3.2%, and the fall was expected to accelerate to 3.6%, but actually it came in at minus 5.4%. So the UK economy is weakening. We also had UK public sector borrowing figures, and they missed expectations, but by less than I was expecting, actually. So the consensus was for August borrowing to come in at 10.6 billion. And in fact, UK government borrowed 11.06 billion. In the EU, we had consumer confidence numbers which bounced, actually, despite everything. So in August, the number was a pretty awful minus 25.8, and the market was expecting it to get worse to minus 29. In fact, it came in at minus 24.9, so a bounce from August, but still awful. In the US, housing starts actually rose in August despite the slowdown in the US housing market. So in July, housing starts were an annualized 1.4 million, and in August they bounced to 1.575 million, defying expectations. But the rest of the US housing market continues to slow. So new building permits fell, missing expectations, and existing home sales also fell, though only a touch, and they did beat expectations. Okay, on to economic update charts. So these are UK retail sales, and you'll see they are falling at 5.4% year on year. There's public sector borrowing in the UK, and the pandemic has destroyed UK government finances. And today in the mini budget, the government is expected to cut taxes, even as it has announced this energy price guarantee that is expected to cost 150 billion. So the UK is on track for further deterioration in the public finances. And that I expect to be very bad for sterling, as we have discussed many times over previous months. UK industrial orders bounced slightly, though they're still in negative territory in September. EU construction output actually is quite resilient in July. EU consumer confidence bounced from record lows to just plain awful. US 30-year mortgage rates continue to rise, and that will destroy the US housing market. And reminder, the housing cycle is the business cycle. As mortgage rates rise, then so borrowers can't afford house prices have to fall, and that means construction activity also has to fall. And that pulls the US economy into recession. We did a special podcast on how the housing cycle is the business cycle. If you haven't watched it, please dig it out from our YouTube channel. Now, in August, US housing starts actually had a little bounce, which was very surprising. And given the fall in house prices and the rise in mortgage rates, you really would have expected the US construction sector to have slowed more than it has. But if you look at housing starts in 2022, which is the red bars, compared to in 2021, which are the blue bars, then you'll see that it really hasn't fallen much yet. But I don't expect that to continue. I think we will see housing starts fall in the coming months as the slowdown in the US housing market accelerates with rising interest rates. And one of the reasons that I expect the US housing market to slow further is that there are a lot of homes under construction in the US, but mortgage applications are falling. So you're going to see a glut of inventory hitting the market just as demand collapses. So then you expect to see falling house prices and developers cutting back. And this is US existing home sales, and that did not bounce in August. So the general picture in the US housing market is of weakness. US jobs market, though, remains resilient. A small uptick in jobless claims, but jobless claims very low by historic standards, and continuing jobless claims low. So in summary, a light data week. The US housing market, frankly, continues to defy gravity despite mortgage rates having more than doubled this year to 6.25%. But I don't think it can defy gravity forever. In the UK and EU, the economies have not slowed as much as I expected, but we're now going into the energy crisis proper this winter. Okay, onto one chart. And this is actually from the Fed via the FT. And what it shows is what proportion of pre-tax earnings US corporations have had to spend on interest and taxes. And in the early 2000s, that was about 47%, and now it's about 26%. So US corporate earnings have benefited enormously from falling interest rates and low corporation tax. But interest rates are now rising, and we know that US corporate debt has massively increased as companies have leveraged up to fund share buybacks. And in addition, further falls in corporation taxes are unlikely. And as fiscal sustainability becomes an issue, I suspect that in subsequent years they're likely to rise. All of that means that corporate earnings face further headwinds from interest rates and corporation taxes in coming years. And onto inflation watch. So we have now had all the inflation data for August, and the picture is of core inflation rising more than expected throughout the Western Hemisphere. We did have some falls in headline inflation due to falling energy prices, but inflation has broadened into services as wages rise, and we're in the preliminary rounds of wage price spiral. That means that central banks are having to raise interest rates higher than they had previously forecast in order to get inflation under control. To give you an idea of the inflationary pressures we are still seeing, this is producer price inflation in Germany for August, and it hit 45.8%. And if the historic relationship between producer price inflation and consumer price inflation holds, that implies German CPI will hit 9.4% from its current 7.9%. Reminder, ECB base rates are currently 0.75%, i.e. hugely stimulatory, and the ECB is way behind the curve on inflation. Monetary policy is still incredibly loose in the Eurozone. One piece of good news for inflation is that the money supply is shrinking in the US, as evidenced by M2. So the quantity of money is falling. So according to the formula, as long as the velocity of money remains the same, then inflation should start to come down. Although you'll notice that the fall in M2 is tiny compared to its rise over the last few years. And we are seeing globally weak credit impulse. And whenever the credit impulse is weak, so you tend to see either a recession, as we saw after the great financial crisis, or periods of weak growth. And now the credit impulse is very strongly negative. So that means that companies are going to find it hard to get funding and to invest, which will weaken economic growth. Now, this is a really important chart. Please pause and take a look. So these bars show how long it took for countries to return to having inflation of 2% when their inflation initially breached 5%. So if we take the furthest bar on the left, which is Greece in 1980, it took 29 years, I'll repeat that, 29 years before Greek inflation fell back below 2%. The average number on this chart is 10. So on average, when a country's inflation goes above 5%, it takes 10 years before inflation comes back down below 2%. So inflation tends to be persistent. But if we look at what the consensus is currently expecting, it's expecting inflation to come down very quickly. So for the UK, they're forecasting inflation just above 2% in 2024. And generally, inflation to be around 2% for most countries in 2024. So the danger is that interest rates and bond yields have to stay higher for longer because inflation refuses to come down. And that is bad for equities. So in summary, during August, inflation proved to be persistent. It broadened into services and was higher than the market had been expected. However, there were some disinflationary effects that brought down headline inflation, particularly in the UK and in the US. And so supply chain disruptions have eased and goods inflation is coming down. Credit growth is contracting. So we have negative credit growth and energy prices are falling. And during August, the contribution to inflation from energy month on month was negative. But what contributed to persistent inflation was that wages are rising and workers are responding to the increase in inflation by demanding higher wages, and that is the start of a wage price spiral. Bottom line, inflation is strong and persistent. Central banks will need to raise rates faster, higher, and for longer, and that is bad for all asset classes apart from cash. So the safest asset class to hold currently is cash. And on to recession watch. Okay, so this is the Atlanta Fed's GDP now forecast for US Q3 economic growth, and you'll see that it is collapsing, and they are now forecasting third quarter GDP growth of only 0.5%. Reminder, the first two quarters in the US had negative growth, which is the technical definition of a recession. So is the US now currently in recession? In the UK, we are seeing a surge in insolvencies before the energy crisis even really gets going. And we've got a piece coming up on UK corporates, and we expect the insolvencies to get worse. And this chart shows UK retail sales, which is the brown line, and after adjusting for inflation of 10%, then you'll see that actually real retail sales are declining and have hardly grown in the last 3 years, which is unsurprising when UK consumer confidence is at a near record low and global GDP forecasts are in free fall. So forecasts for the UK for 2023 are now negative. So the economists are forecasting a recession, although frankly, I think that forecast, minus 0.1%, is way off the mark. And I think both the UK and the Eurozone are going to have very strong negative growth next year. And I think the US will also fall into recession. And part of the reason that economic forecasts are now negative is that interest rates are rising and rising fast. And that sucks demand out of the economy. That is because inflation is persistent. Now, the UK energy price guarantee means that actually inflation will not be as high as previously forecast because energy price rises for consumers and businesses won't rise as much as if they had been exposed to market forces. So that means that the Bank of England's forecast for inflation is now it will peak around 11% next year. But the Bank of England has massively revised its expectations for UK interest rates. Last month, it forecast that rates would peak around 2.75%. It is now forecasting they'll peak about 4.75%. Essentially, the UK government has announced this enormous £150 billion package to support energy bills while also cutting taxes. So you're going to see a deterioration in the UK fiscal balance, which will feed through to a deterioration in the trade balance. And that means falling sterling, rising inflation, and the Bank of England having to push against persistent inflation with higher interest rates. So the black line is UK interest rates over time, and you'll see that the Bank of England's forecast of 4.75% interest rates in a historic context doesn't look too bad. I mean, you're only getting interest rates back to where they were pre-GFC. But, of course, the debt burden has grown enormously since then. And so if you adjust for wages and the amount of debt in the economy, so how will those rates feel to UK businesses and consumers? And adjusted for affordability, those rates, which is the red line, are now going to be tight. So the impact of those interest rates will be similar to as they were pre-GFC, i.e. they've only been tighter before the Great Financial Crisis and in the late 1980s and early 90s. And when we look at the impact of rising interest rates, well, here's a live example from the US. So this is the monthly mortgage payment on the median house in Austin, Texas. Now, in 2012, that was about $706 a month. In 2020, it was about $1,200 a month. But rising interest rates and rising house prices mean that it is now over $3,000 a month. So rising interest rates plus rising house prices mean rising mortgage payments, which means a huge drop in housing affordability, which must mean a fall in demand. And that means house prices have got to fall, housing cycle slows down, and with a lag, the economy slows down. Reminder, the housing cycle is the business cycle. And the bond market is forecasting recession. So Yield curve inversions have 100% record of forecasting recessions, and the 10-year minus 2-year is currently at some of its most negative on record. So in summary, growth forecasts are weakening, mortgage rates are rising, interest rates are rising, and the Fed is committed to slowing the economy to create some slack in the labor market to moderate wage inflation and get inflation under control. So don't fight the Fed. The Fed is trying to induce a recession in the US. And on to European energy crisis watch. Well, it's getting real. So this is a gas bill posted to Twitter by an Italian company which processes tomatoes. And you'll see that in 2021, its bill was 120,000 euros. This year, 979,000 euros. So a massive increase that is simply unaffordable. And this is going to create a great deal of unhappiness, political chaos, frankly. We have Italian elections this week, and corporate stress leading to insolvencies and a deep recession. And I should thank one of our Discord members, Giovanni79, for translating the video for me. It was in Italian. And as you know, the French are always ready to protest. And as the cost of living crisis bites, so we expect to see a lot of protest around France and disruption. And one of the first casualties of the energy crisis is going to be solidarity. So France is considering cutting off power exports to Italy this winter in order to conserve its own electricity. Now, reminder, Italy produces around 25% of its own power and is dependent on both gas and electricity imports for the rest. So that will cause problems in Italy and rising Italian prices. European solidarity is fraying. Now, in Germany, the utility Uniper has been nationalized by the government because it had contracts to buy a load of Russian gas. Russia cut off the gas supplies, and then it had to source expensive alternatives. And that means that it has incurred huge losses and was about to go bust. And this chart shows how much energy costs have increased in Europe. So if we look at the UK, in 2020, the UK was spending around 2% of GDP on energy. In 2022, it's going to be about 8%. Now, mainstream economists do not seem to think this impacts economic growth. And you've seen that earlier, they're now forecasting UK GDP to just contract by 0.1% in 2023. But I think the impact is going to be much bigger. Consumers are going to be spending more of their money on energy and have less discretionary spending, and that is going to feed through to lower business revenue, lower business investment, and etc., etc. And I think that we are likely to see a hard recession in the UK and Europe in particular. And as evidence for that, if we look at the history of energy price rises, every time we've seen an energy price spike, there's been a hard recession. So you see a leap in energy prices in 1973-74 due to the OPEC oil embargo caused by the Yom Kippur War. There was a terrible recession. And then in 1979, we had the Iranian Revolution leading to an oil price spike. Again, terrible recession. And then remember, in 2007, 2008, oil prices hit $146 a barrel. Now, everyone remembers the subsequent recession as being caused by the great financial crisis. But a contributory factor was the massive rise in oil prices. And we now have this enormous spike in 2022. If history is a guide, expect a very bad recession. So in order to cushion the impact of energy price rises on consumers and businesses, governments are socializing energy bills. So this chart from Bloomberg shows how much European governments have allocated towards energy support bills. Now it's quite a crude table because it doesn't tell you how long those schemes are due to last. So some of those schemes may only last 1 year, and some of them, such as the UK scheme, cover longer than that. So the UK scheme is due to last 2 years. But what's certainly the case is that you're going to see deterioration in fiscal balances, and governments are going to be buying gas instead of consumers. And the danger is that by subsidizing energy bills, consumers and businesses do not feel the full impact of price rises and so do not cut back as hard as they otherwise would. And so we then have governments having to buy lots of energy in the markets against each other, forcing prices higher. Reminder that the price that consumers face for energy, and in this case, petrol or diesel, is also largely taxed. So if this table compares the price of filling up a Ford Transit van with diesel in different countries, and the price is highest in the UK due to UK diesel taxes being the highest in the world. But not all is doom and gloom. German electricity prices have actually fallen hard in the last few days. But December German electricity futures have not fallen to anywhere near the same extent. So what's happening is that we are now in an autumn lull. The drought that was affecting hydroelectric production and nuclear power production in France has now passed, and so power generation is normalizing, and as yet winter heating demand has not kicked in. But in the coming months, that will change. So in conclusion, the severity of this winter's European energy crisis will depend in part on the weather and energy demand. We have a piece coming up on whether we think European governments will actually be able to source all the LNG they need to support energy demand without rationing. And spoiler alert, we don't think they can. So what are the investment implications? Well, during this winter, European governments are going to be selling sterling and euros to buy LNG mainly from the US. So trade deficits are going to widen. They're going to be relentlessly selling sterling and euros. Interest rates are rising. So you want to be in safe havens, but preferably not euros or sterling. So that can mean US dollars, gold perhaps. Actually, gold, despite selling off in US dollars, has held up well in sterling and in euros. And world government bonds, perhaps, although it's a bit early. And on to the UK energy price guarantee again. Okay, so this week we had details of the UK business energy subsidy, and that will more than halve the energy bills of UK businesses. So electricity prices will be capped at 21.1p per kilowatt hour. Current market prices for winter futures around 49p, and at 7.5p for gas. market prices for the winter are around 17p. So prices relative to the market will be more than halved. And businesses will pay substantially less than consumers for their energy. So businesses are seeing their electricity prices capped at 21.1p per kilowatt hour. Domestic bills are capped at 34p and 7.5p for businesses for gas relative to 10.3p for consumers. These are market prices for electricity, and I've put on the red line of where the cap is. So businesses, although they won't experience the extremely high rate seen in the market, they will face a trebling of their energy bill from 2020 levels. Now, last week we were talking about how the energy package is unfunded and essentially relies on international investors buying sterling so we can pay for gas priced in dollars. And we were very negative about the outlook for sterling. Well, the FT has caught up with us, and Martin Wolf this week talking about how Britain's energy package puts our economic credibility at risk. Now, while we've been on air, the UK has had the mini budget, and the new Chancellor, Kwasi Kwarteng, has abolished the higher rate of income tax. 45p is now gone, and rates of 40p, this highest rate, and has also cut income taxes from 20p to 19p. So while we are seeing this enormous 150 billion energy price guarantee scheme, we're also seeing the government cutting taxes. Now, what it aims to do by doing this enormous fiscal stimulus at a time when the unemployment rate is very close to an all-time lows, I just do not understand. This sort of trickle-down economics has been tried before, and it's always been a bit of a disaster, frankly. So Liz Truss, who had a brief career as an accountant, seems to think that she understands economics and what the best economic policies for this country are much better than do professional economists. And whenever world leaders without a background in economics decide that they know better, the outcome is generally disastrous. I'm thinking here of President Erdogan, for one. So as private citizens, we can't affect idiotic government policy. The only thing we can do is try and steer our little pot of savings through the economic storm that is coming. And we've been talking for months now about the outlook for sterling and how the unfunded energy price guarantee scheme would lead to further sell-off in sterling. Well, that is happening. And I am very pessimistic about the outlook for sterling, and we have more on that in a bit. But the mini budget appears to have realized all my worst fears of the fiscal deficit exploding at the same time as the trade deficit explodes, undermining Britain's credibility for fiscal rectitude, leading to a sterling crisis. And frankly, I'm very worried about the outlook for sterling, and I think we may once again end up in the arms of the IMF. So the cost of the energy price guarantee is expected to be around 150 billion, but that will depend on how long the energy crisis lasts and how high gas prices go and how hard the winter is. So in addition to this fiscal largesse, the government is also committed to cutting taxes, so the fiscal balance is going to deteriorate badly. Last week, we did our own calculation on how the various elements of the government's energy subsidy schemes would combine. And we calculated that energy prices would fall for the average household in October when the price guarantee combined with the £400 energy subsidy came in. But the Resolution Foundation have done their own calculation, and they think that energy prices for the average household will rise, but only by 7%. So their forecast is the blue line. The dark blue line is what would have happened if market forces had been left to prevail. So these energy subsidies will have the effect of cushioning consumers from most of the rise in energy bills. But the reason that the government scheme come under a lot of criticism is, although in percentage terms, poor households will receive the biggest subsidy, in absolute terms, in hard cash terms, most of the money will go to the richest households. And thank you to our Discord member, Legion852, for sending me this. This is UK energy consumption quarter by quarter, and we consume most of our gas, as you would expect, in the winter months because a lot of our domestic heating is gas powered. We showed you this chart earlier, but to offset the increased fiscal spending, the Bank of England will have to raise rates higher than they've previously been expecting, and they're now forecasting a peak in rates of 4.75%. But I mean, these forecasts were from earlier in the week, I think before they'd got the details of the government's plan to cut taxes. So rates may have to rise even higher. And the fall in sterling means that inflation is going to be persistent. Now, this is from Paul Johnson of the Institute of Fiscal Studies, and this is before we got the details of the mini budget. And this is just talking about the energy price guarantee. And he said, the failure to provide any official sense of costing was extraordinary and deeply disappointing. I would call it frightening. And so the energy price guarantee essentially equates the UK government having entered into a huge short position on LNG, just as we're entering the winter months of an energy crisis. How bad it will be depends on how hard the winter is and how other countries also support their consumers, because cushioning consumers and businesses from market forces means that they're not as incentivized to cut back on their energy use as much as they otherwise would have been. And if all the governments of Europe do the same, then demand for LNG and energy will be higher than it otherwise would have been this winter. So energy prices will be higher. I worry about sterling. We are committed to selling sterling this winter to buy LNG priced in US dollars. And the more sterling falls, the more sterling we're going to have to sell to buy the same amount of LNG. A sterling crisis is a distinct possibility. And on to the outlook for UK businesses. Well, UK businesses are seeing rises in materials and costs, particularly in energy. And they are also seeing high wage inflation. So wages in the construction sector have risen 25% in 3 years. So businesses are seeing higher costs, including higher interest costs on their debts. And UK corporates have a lot of debt. According to the Bank of International Settlements, they have debts of $8.5 trillion. So as interest rates rise, post-tax profits will fall. So while their costs rise, their revenue is also under pressure as consumer confidence falls and consumers cut back on their discretionary spending. So UK corporates are being squeezed from both sides. And that means you're going to see falling profits, higher insolvency rates, higher default rates on loans because of lower corporate earnings. And as the default rate rises, we'll see increased stress on the financial system. Okay, and on to the outlook for sterling. Now, I should say that since we've been on air, sterling has fallen again. The markets have taken the mini budget very badly. UK bonds have sold off. The UK 2-year has risen by 50 basis points while we've been on air. And sterling is now at around 110. And even before the mini budget, which has loosened the purse strings, the UK trade deficit was the worst on record at 8% of GDP. The UK is not paying its way in the world. And the reason the trade deficit has deteriorated is largely because of rising energy prices. And our trade deficit is the worst in the G7. Brexit added a load of frictions in trade between us and our largest trading partner, the EU. So as we have recovered from the pandemic, so Britain's export growth has been the lowest of developed countries. So the fall in sterling is not creating an offsetting increase in our exports that would narrow the trade gap. Britain has historically been a high inflation country, and if you adjust the exchange rate for the relative labor costs of Britain versus the rest of the world, actually, even though sterling is sold off, it remains overvalued. So just adjusting for labor costs, sterling is expensive still, despite its falls. However, if you look at the Economist Big Mac Index, then it says that sterling is undervalued versus the dollar. Now, reminder, the Big Mac Index is a sort of purchasing power parity proxy, which just looks at the price of McDonald's Big Mac in different countries. So according to that, sterling is undervalued. But sterling is trending down. In order to call a bottom to that, you would have to say the cycle is turning. Now, my own thoughts on the cycles is that cycles and trends last much longer than you might expect. Think of the great financial crisis. We had the first intimations that there were problems in subprime in 2006. In 2007, the problems got worse, but equity markets remained convinced that those problems were contained and rallied. It was only in 2008 markets came off. The crash didn't happen until October 2008. Markets bottomed in March 2009. These cycles play out over very long periods, in part because the financial system is a multiplier and it's opaque. So we won't know about stresses in the financial system until they can no longer be disguised. And you then have to deal with the secondary effects of stresses in the financial system. And in the UK, we're going to have a deep recession caused by the energy crisis, the fall in sterling, and rising interest rates. And all that puts stress on the financial system. It is too early to be buying sterling or buying UK financial assets. When thinking about your investment strategy, 90% of the time, you should be following the trend. You should only be contrarian 10% of the time. And trends change when their underlying causes have been addressed. And right now, the fundamentals driving sterling lower remain in place. And until we have an end to the energy crisis or some fiscal rectitude in the UK, then I foresee sterling going lower. To me, after the mini budget, it is clear that sterling is likely to fall to parity with the dollar. And frankly, I can see it falling further. So the bottom line is this winter, the UK will be selling sterling to buy LNG priced in US dollars. As sterling falls, we'll simply have to sell more sterling to buy the same amount of LNG. You can see sterling getting into a terrible negative spiral that will continue until either the government raises taxes, Bank of England raises interest rates high enough to make sterling attractive to foreign investors, which would mean having positive real interest rates and real interest rates that are substantially higher than in the US to make the UK an attractive destination for international capital, or it cuts subsidies to cut the trade deficit. Now, all of those would be bad for the economy. So I think the UK is in for a difficult year. On the Discord channel, when I've been talking about the outlook for sterling and how pessimistic I am about it, I've had some pushback about how sterling is undervalued or fair value against the dollar, and that will support it. But against that argument, I would give you this chart, which is the Big Mac index for the Japanese yen, which shows the Japanese yen is 45% undervalued against the dollar. So just because a currency is undervalued doesn't mean it can't continue falling if the forces driving it lower continue in place. And reminder that in Japan, interest rates are minus 0.1% and QE continues. This is the yen. In the last day or so, Japan, the Bank of Japan has actually intervened in the market to push the yen higher, but the fundamental forces driving it lower are in place. And as soon as they stop buying yen, then I'd expect the yen to start falling again. Okay, now can the EU actually buy enough LNG this winter to keep the lights on? Now, on Twitter, Alexander Stahel has done a calculation where he thinks that the EU is going to need to buy 271 billion cubic meters of LNG in next year to keep the lights on and refill stocks. Now, can they actually get 271 billion cubic meters of LNG? Is that available? Well, the first problem is, even if you could buy it, can you get it to the right places? Because although the EU has sufficient regasification facilities at the moment, they're in the wrong places and poorly connected. So, for example, Spain and Portugal have very good regasification facilities, but they only have one poor connection via France to mainland European gas pipelines. And so all that means European regasification capacity is essentially maxed out currently at about 150 billion cubic meters per annum. You can see here, despite the energy crisis, regasification capacity utilization is only running at about 70%. Now, as we covered last week, this winter, there are plans to have a further 7 floating regasification facilities in action, which will partially resolve the problem. So the next question is, can the EU actually source the necessary LNG? Well, LNG liquefaction plants are enormous pieces of industrial machinery which take around 6 to 8 years to build. And in order to de-risk those projects, generally their LNG output is sold in advance on fixed price long-term contracts. Now, this year, Europe has sourced 75% of its additional gas from the US. Now, the reason they have been able to do that is the US is unique in that its long-term contracts have no final destination clause. So the contracts essentially say, I have sold you this LNG cargo at X price, and you can then do what you like with it. But most LNG contracts are not like that. Most, particularly Asian ones, have a final destination clause. So not only does it specify what the price is, but it also specifies where it must be delivered to. So Asian LNG cargoes cannot normally be resold. And that means there's only a limited amount of LNG available to Europe. If we compare current LNG prices to historic prices, then obviously current prices are much higher than they were 3 years ago. So if you had bought LNG on long-term contracts pre-2020, you would have paid between $6 and $10 per million BTU, whereas currently you're seeing prices of around 60. So you've got a huge incentive to try and resell those cargoes on the spot market. But can you? Well, in some instances, it is possible. For example, this Singapore trading company had a cargo that it was originally contracted to deliver to India, but there was a break clause in the contract equal to 20% of the original value of the cargo. Now, it then paid the break clause because that penalty equated to just 4% of the current value of the cargo on spot markets. So if other cargoes have similar break clauses, that means that they can be diverted to Europe. The amount of gas that becomes available that Europe will be able to buy depends on the idiosyncrasies of individual cargo contracts. Bottom line is, Europe will not be able to divert most of the cargoes destined for Asia on long-term contracts towards itself this winter. So last week, I was discussing the possibility that Europe and Asia would get into a price war over LNG, and actually that is less likely. But what they will do is get into a bidding war over incremental supply from the US and elsewhere. This table shows European gas supplies and where they've come from. And you'll see that in 2021, Europe got 17 billion cubic meters from the United States. This year, it's almost trebled to 45 billion. So the US has been Europe's marginal supplier. What is the outlook for further growth in US LNG supply? Well, it's not great. Essentially, these projects take many years to complete, and after very strong growth in the last 10 years, we are now going to face a period in which there are no new projects coming online for the year 2023. So the high price signal will not lead to an increase in supply until 2024. And matters are made worse by the explosion at the Freeport LNG terminal. And you'll see that actually US LNG exports have fallen over the first half of the year because of it. Now, Freeport should be back online in Q4. The other thing to say is that US LNG export facilities are concentrated in the Gulf of Mexico, and it's hurricane season, and the hurricane season is forecast to be worse than average. Now, this is the situation as of this morning. Hurricane Fiona has missed mainland US and is heading off into the Atlantic, but we have a storm forming above South America, and we don't yet know how bad it would be and where it's going to head. So a bad hurricane season could cause problems for US LNG, which would be very bad for Europe. So in summary, actually, Alexander Starhill doesn't think Europe will be able to source sufficient LNG supplies this winter for normal consumption. Europe will not get into a price war with Asia for its supplies because most of Asia's supplies are on long-term contracts. So that means that Europe will have to cut its consumption. Now, how it achieves that when government subsidies are getting rid of the price mechanism, I don't know. Watch this space. Okay, and on to other charts. Now, this chart shows the prevailing market trends, and all of them remain intact. So the dollar's rising, bonds are falling, Bitcoin's falling, stocks are falling, the Japanese yen is falling, gold is falling. And it is too early to call a turn. So I expect all those trends to continue. Now, the dollar index is rising, and we'll show you some data later. But the reason the US can be expected to do much better than Europe, including the UK, is that the US has much lower energy bills. So in 2022, the US is expected to spend around 5.3% of GDP on energy. In Europe, that's 11.7, double what the US is spending. That will divert money from businesses and consumers and send it to the Middle East, amongst other things, which will reduce consumer demand and reduce economic activity. Now, we've seen rising interest rates, and that is causing house prices to fall. So we're seeing sharp falls in house prices in the cities around the world where we've seen the strongest rises post-pandemic. Now, how quickly home buyers experience the effects of rising interest rates depends on how many home buyers have variable rate mortgages. Now, Australia is the most exposed because almost all Australian home buyers have variable rate mortgages. So the moment the central bank raises rates, they start to pay more. In the UK, actually around 45% of home buyers have variable rate mortgages. And so the Bank of England rapidly raising rates will mean their housing costs are increasing. So they will have to cut back further on discretionary spending. Now, in China, the non-performing loan figures look really bad. So the blue line is private property developers, and their default rate is currently at 48%. But the state-owned enterprises, their default rate is 15% and rising, leading to a blended rate of 29%. We're seeing a very high property loan default rate in China. That should lead to stresses in the financial system. Will China see a full-blown financial crisis? Now, last week, we talked about the tax burden in the US, and whenever you see the tax burden going above a 20% threshold, you generally see a recession. Well, tax collections are high, and that means that money is flowing out of people's pockets. So the tax burden is another portent of a recession in the US. And in the US, record US government debts plus rising interest rates mean that their expense bill, interest expense bill, has also risen. It's risen very quickly. So in January 2021, they were spending about 500 billion a year. It's now over 700. So that's a 40% increase in their interest expense in 2 years. So in 1 year, sorry. So fiscal sustainability is not on a good path in either the US or the UK. So taxes at some stage will have to rise. And pause, take a look at this. We have talked about how rising interest rates tend to induce a financial crisis as over-leveraged borrowers become unable to pay their bills. Now, Warren Buffett has this saying about when the tide goes out, you see who's been swimming naked. And as the economy slows down and interest rates rise, we're going to find out who is exposed. Now, returning to discussions about the US housing market, the current yield on renting out a single family property in the US is about 4.5%. But 6-month US Treasury yields are about 3.7%. So the gap between the two is closing rapidly. So when you can get 3.7% just sticking your money in the bank, why would you have all the hassle of looking after tenants, house maintenance, etc., for just a very small pickup in yield? Surely US house prices have to fall until the rental yield is at a decent premium once again. And that is another headwind for the US housing market. So on to the checklists and equity markets. Well, it was a bad week for equities. All share down 1.8%. Stocks Europe down 3.2% and down 18% on the year. The S&P is once again in a bear market, down 3.7% on the week, 21% on the year. The NASDAQ down 4% on the week, down almost 30% on the year. Bitcoin is just slowly subsiding, down 2.6% on the week, down almost 60% on the year. To reiterate, I think it's a speculative asset with zero value, and I think it disappears in a puff of smoke, leaving behind a huge electricity bill, but nothing else to show for its brief existence. Sterling has fallen 2%. These figures were first thing this morning. Sterling has since fallen further. The euro is also down 2% on the week. The dollar has risen strongly, up 1.7% on the week, and is rising in a linear fashion. So this is the S&P 500. Sterling, well, since we've been on air, it's fallen further. Now, reminder, I have been warning about sterling since at least the summer before we went on holiday, and those warnings have been absolutely correct. The dollar index continues to rise. Now, US PMIs are falling, and historically, there is a strong correlation between PMIs and corporate earnings. So that should mean that corporate earnings follow PMIs lower in the coming months. Although everyone seems bearish about equities, so far we are not seeing a stampede out of equities. So this is household flows into equities. That's the blue lines. And it is the rolling 2-year sum. So over the last couple of years, you've seen net inflows into US equities of around 4 trillion. So if households start to adjust their asset allocation in line with their sentiment, you'd see outflows and that selling pressure driving the S&P down further. When we look at cumulative flows into the equity markets of different countries, you'll see that European equities have actually seen net outflows over the course of the last year, whereas the US has seen net inflows. Now, I should caveat these charts by saying Rich and I still don't really understand how you calculate these, because how can you have a net inflow or outflow given that for every seller you have to have a buyer? Finally, there's also a relationship between interest rates and the P ratio of the S&P 500. And as interest rates rise, and that is the blue line, the 10-year Treasury yield inverted, so we expect to see the P ratio of the S&P 500 fall. And that's before a recession means that the E in PE also falls. So rising interest rates portend lower equity prices. Okay, onto commodities and energy commodities. Well, poor week, Brent down 1.5%, although still up 16% on the year. WTI down 3%. Good news in Europe in that natural gas was down 10%, although still up 162% on the year. UK natural gas down 26% on the week, only up 70% on the year. Hurrah! So perhaps the UK government will get lucky and LNG prices will not be as high as expected this winter. US natural gas prices also fell, down 13%. Coal was down 2%, although still up best part of 160% on the year. Uranium down 1.5%. Now, some data specific to the oil market. Well, we had inventory builds in the US. So the US oil market was well supplied. And inventory releases from the SPR just added to a private sector glut. So as the world economy slows down, oil demand falls. And historically, recessions have led to big drops in oil prices. Reminder, the oil market suffers from very low demand elasticity. So small changes in demand lead to big falls in price. And so as the economy goes into recession and demand falls, price drops precipitously. And US oil production remained unchanged, still at 12.1 million barrels, a very disappointing rise of only 300,000 barrels on the year. But the Baker Hughes rig count bounced back this week, up 8. So this is the Brent price and drifting off. Now, one of the reasons that the oil price has been weak is that normally you see strong incremental demand growth from China, but this year we haven't seen it. In fact, Chinese oil demand, as measured by how much crude they are processing, has fallen by 1 million barrels a day. Now, as lockdowns ease, that may bounce back, but obviously we have concerns about the strength of the Chinese economy. And if there is continued slowdown in the property sector, that means a general recession in China, then it may not bounce back and it may actually fall further. These are European natural gas futures, come down a long way from their peak, but they're still more than double what they were 6 months ago. These are UK natural gas futures, which have come off nicely. Now, the fall in UK gas price is not due to a pickup in wind. This is the national grid status as of this morning, and 70% of our electricity was being generated from gas. Only 6% was coming from wind. These are US natural gas futures. As the Freeport LNG terminal comes back online, you would hope that that would add to demand and gas prices might pick up again. This is coal, no indication of a change in the trend. And coal is actually now more expensive than oil on an energy basis. And this is uranium, which seems to have found a bottom. Now, last week in the weekly, I showed a chart of the energy density of various fuel sources and how uranium was literally 1 million times higher than anything else, and commented that nuclear was the answer to the energy crisis. And I got some pushback on comments from the YouTube channel. And no energy system is entirely safe. So this picture is from the 22nd of September 1934, when an explosion at Gresford Colliery in Wales killed 266 men and boys. The wages of everyone, including those killed, was docked by half a day's pay by the owners because they were killed midway through the day and they failed to complete their shift. Now, I contrast that with the Fukushima nuclear disaster, which killed one person through direct effects of radiation. Yes, one person. Go and read the UN report. It did, however, kill a further 2,200 people due to the evacuation, mainly through adverse health effects caused by loneliness. And my point is that no energy system is entirely free of risk, and nuclear is the best option for getting us out of our current energy crisis. Okay, on to industrial commodities. And a mixed week. Industrial commodities generally were quite weak. Aluminium down 3.6%, copper down 1.6%, iron ore down 3.8%, but neodymium bounced back, as did nickel. Some charts. There's aluminium drifting off despite the closure of lots of European aluminium smelters. Cobalt seems to have found a bottom. Dr. Copper is diagnosing a weak world economy. Chromium drifting off. Iron ore drifting off. Lithium, we have a global lithium shortage caused by the boom in global electric vehicle sales. Essentially, there's not enough lithium to meet demand. Neodymium seems to have found a bottom, we hope. Nickel, likewise. Tin, flat. Ferrovanadium continuing to drift off. Zinc, subsiding. Okay, on to precious metals. Well, gold actually did okay in US dollars, up 0.6% on the week. Silver bounced a bit, but is still down 16% on the year. Gold has been very disappointing in US dollar terms, but its value has held up in other currencies. Platinum, rhodium both had poor weeks. Palladium bucked the trend, up 2.8% on the week. Now, reminder, Russia is a key supplier of palladium, and that saber rattling may well be behind fears over supply and the rising price. So this is gold. No sign of a turn in the trend. And the blue area at the back is gold holdings in ETFs. And what you see is that it changes in line with the price. So people buy gold ETFs when the price is rising. Gold is a speculative asset. This is silver, platinum drifting off again, rhodium flat, palladium pretty stable. And finally, on to rates. Now it is 2 o'clock in the afternoon in London, and I have updated the UK rates after their sell-off from the mini budget. So we've seen big changes in UK rates today. But a reminder, earlier in the week, we saw the Fed raise its interest rate by 0.75% to just over 3%, and we saw UK base rates rise by 0.5% to 2.25%. But the UK yield curve has shifted substantially higher today. So the 2-year sold off by 50 basis points this afternoon after the mini budget and is up 80 basis points on the week. We've seen the whole yield curve shift upwards. Now, in the Eurozone, we've also seen rising rates this week. And reminder, Italy has $3 trillion of debt. And at current rates, its solvency has to be called into question. Now, the recent rise in bond yields has decisively broken the bull market. But bond yields are way above their 200-day moving average and are beginning to look oversold. What is certainly true is that bond investors have had an absolutely appalling year, the worst on record. And one of the reasons that US bond yields are rising is that the Chinese are no longer buyers. So Chinese ownership of US treasuries actually peaked just after the great financial crisis. And so with China no longer buying, who is going to step up to buy US government debt and fund the enormous fiscal deficit? Now, central banks are raising interest rates to get inflation under control. And their plan is essentially to raise interest rates until the economy slows down. Now, is that plan effective? Does a recession reduce inflation? Well, the answer is yes, it does. And so the table on the left shows every recession since 1923, and the column on the right shows the change in inflation. And you'll see that in every case, there was a big drop in inflation, and often at the trough, there was deflation. So you'll see in 1923, inflation bottomed at minus 0.6. In 2008, it bottomed at minus 2.1. And the change, peak to trough, post GFC, was minus 7.7%. So if central banks can induce a recession by raising interest rates, that should bring inflation down, and that should translate to lower bond yields. So this is the UK 10-year. You see today, after the mini budget, it has sold off enormously. And essentially, that is investors voting with their feet, not wanting to hold UK bonds, demanding a higher risk premium, an inflation risk premium, to hold UK gilts. This is the 30-year, again selling off. Reminder, the Bank of England has a 2% inflation target. And what the gilt market is saying is that it doesn't believe it anymore. The Bank of England is losing credibility. This is the US 10-year. This is the German 10-year bond yield. Earlier in the year, the Bund yield was below zero. You had negative yields on German 10 years. It's now approaching 2%. That is an enormous change. This is the Italian 10-year, 4.1%, having been just over 1% at the start of the year. And the chart on the left shows the change in ownership in Italian bonds over the last 20 years. And essentially, in the last 5 years, there has been a net transfer of Italian bonds from the private sector to the ECB. The ECB has bought more than 100% of all new Italian bond issuance. Now, as the ECB steps back from its bond buying program and raises interest rates, Italy becomes exposed to market rates. There's big danger of a solvency crisis in Italy. On the right shows Spain and a similar pattern. So this is Greek 10-year. Reminder, most Greek government bonds are held by institutions, so it's not really exposed to market forces in the way that Italy is. If there's going to be a crisis in the Eurozone, Italy, not Greece, will be the catalyst. And finally, the seasonality chart. Well, choppy period before things get interesting in October. So concluding comments, well, batten down the hatches. We're heading into October, the worst month in the year, and an energy crisis. So be safe, cut your risk, be very careful about taking any risk. Once again, apologies, there's no Richard this week as he has flu, so you've just got me. Well, what did I do this week? Well, I had an okay week, up 0.6%. The all shares down 1.8%. But I am having a good year, particularly relative to the all share. Now, I did a bit of tinkering this week. I sold some of the iShares 1 to 3 year Treasury ETF, which I have been using to get exposure to the US dollar. Reminder, last week, we discussed the Lixor US cash ETF, whose ticker is FEDG, and that is a better bet if you just want to get your money out of sterling into US dollars. The 1 to 3 year is exposed to the prices of 1 to 3 year bonds, and they have been falling as US interest rates rise. Now, if I had known about FEDG when I originally put this trade on, I would have used that instead. Now, what did I buy? Well, i3 Energy are drilling the Serenity exploration well in the North Sea, and I'm a sucker for exploration wells, despite all the lessons of the past which should tell me to avoid them. So I have bought a small position, and I also added to my position in the US 20-year plus ETF. Now, at some stage, the US will go into recession, and I expect bond yields, long bond yields, to fall substantially. But I have been early, and the sensible thing would be to wait for the turn in the interest rate cycle. But once again, I've been impatient, but only with a small part of my portfolio, I should add. So this is my portfolio at the start of the week, and this is my equity allocation. Now, one of my few remaining equity holdings had a terrible week. So Entech Technologies, which does measurement while drilling technologies, warned of increased competition and missed revenue targets. Its shares fell 40%. Now, I have a position of 0.8% of the portfolio in that. So that hurt, a loss of 30 basis points. But the reason I'm invested in Entech is because of their Sabre rotatable steering system, which they are developing using technology that they acquired from Shell. And the market for those systems is much bigger. That seems to be going well. This company is now absolutely tiny. And if it shows any progress with Sabre, then the shares could fly. So I'm sticking with them, but I'm not adding to the position. This is i3. Reminder, I sold my i3 at an average price of 28.5p back in May. And today I have bought back in at 24p, small position, because I like a bet. And we will see whether finally one of these exploration wells comes good. Fingers crossed for all holders. This is the iShares US Treasury 1 to 3 year ETF. Should be ETF, not ETC. And it's done okay. And also, it's a distributionary ETF. So next week, I get half-year dividends. And as the yield has risen, those actually become quite substantial. And this is the 20-year plus ETF, that should be. The fall in sterling has been offset by falls in the price of the underlying treasury bonds. So it's not been great, but it's not been disaster either. And these are US Treasury bonds, the 30-year. Now, if the US goes into recession, I expect yields to fall. And then you only have to have yields go back to where they were in July to see a 15% return on your investment. So that's going to be my game. I'm looking to play the change in the capital value of long bonds as the interest rate cycle turns. So I'm not aiming for yield, I'm aiming for capital growth. Now, obviously, I've been early, but I remain convinced and committed to this trade. Okay, that's it. Thank you all for watching. I apologize for the absence of Richard. It is much more fun for both of us when he's here, but hopefully normal service will be resumed next week. In the meantime, please can you press like and subscribe to the channel. And it's goodbye from me, Keith Jordan. Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.